Hi, let's dive into embedded options and embedded credit derivatives and how they are assessed in financial contracts. Let's start with embedded options. These include features like call options, put options, or prepayment options that are part of a debt or insurance contract. Whether these options are considered closely related to the main contract depends on a few key factors. For example, a call or put option is closely related if its exercise price is approximately equal to the amortized cost of the debt instrument or the carrying amount of the insurance contract on the exercise date. For prepayment options, the exercise price needs to account for the lender's potential loss. This means compensating the lender for the present value of lost interest over the remaining term. This calculation typically factors in the difference between the contract's effective interest rate and the rate available for reinvestment at the prepayment date. These relationships are assessed before separating the equity component in a convertible debt instrument as outlined in accounting standards like Ind AS 32. Now let's talk about embedded credit derivatives. These derivatives are embedded in a host debt instrument and are designed to transfer credit risk from one party to another. Here's how it works. One party, often called the beneficiary, transfers the credit risk of a reference asset to another party, the guarantor. The guarantor assumes the credit risk but doesn't necessarily own the underlying reference asset. For instance, if the reference asset defaults, the guarantor absorbs the loss instead of the beneficiary. Since the economic risks of credit derivatives differ significantly from the risks of the host debt instrument, these derivatives are treated as separate components. Thanks for tuning in. See you next time.